Imagine this. A stock has been moving sideways for hours. Suddenly, volatility expands. The price explodes upward and touches the upper Bollinger Band. Most beginners immediately think the stock is overbought and decide to short it. Minutes later, the stock keeps climbing and squeezes them out of their position. What went wrong? Today, we are going to break down Bollinger Bands the right way. This isn't just a basic overview. It's a technical masterclass on turning a volatility indicator into a high-probability framework for the U.S. stock market. We will explore how they really work, the math of standard deviation, and the exact setups for mean reversion and trend continuation. By the end of this video, you will trade the context, not just the touch. To master the tool, you must understand its origin. Bollinger Bands were developed in the early 1980s by John Bollinger. At the time, static trading bands were the norm, but they failed to account for the dynamic nature of market volatility. Bollinger realized that for a technical tool to be truly effective, it had to adapt to current conditions. He integrated the concept of standard deviation to create bands that expand and contract automatically based on the speed of price movement. His breakthrough allowed traders to define high and low prices relative to a moving average, providing a statistical context that was missing from previous indicators. This was the birth of adaptive technical analysis, designed specifically to handle the violent shifts in liquidity found in the U.S. equity markets. Bollinger Bands consist of 3 lines: a middle line, which is usually a 20-period simple moving average, and 2 outer bands plotted exactly 2 standard deviations above and below that average. But why 2 standard deviations? In statistics, under a normal distribution, approximately 95% of all price data should fall within these 2 outer boundaries. This makes the bands a powerful volatility gauge. When the bands widen, it proves that the price is dispersing further from its average. Volatility is high. When they contract, the market is stable and prices are tightly clustered. This is critical. The bands measure volatility relative to recent price action, not absolute overbought levels. You are looking at the statistical stretch of the market. Understanding this math is your first step toward professional precision. The most common mistake is believing that every touch of a band is a reversal signal. This is simply not true. Before looking at the bands, you must understand the environment. Are you in a trending market or a range-bound market? Bollinger Bands work best in range conditions for mean reversion strategies, where the price is trapped between support and resistance. In strong trends, however, they work better as continuation tools. In a powerful move, the price can walk the band for extended periods, touching the upper limit repeatedly as momentum accelerates. If you fight this move without context, you are fighting the institutional current. A professional trader first identifies the trend regime, then uses the bands to time the entry within that specific context. Environment dictates strategy. Let's discuss the hard numbers. If you use Bollinger Bands alone, buying every touch of the lower band and selling every touch of the upper band without any filters, historical testing on liquid U.S. stocks shows a win rate between 48 and 55%. That's essentially a coin flip after accounting for slippage and fees. The reason is simple. The indicator can't distinguish between a minor bounce and a major trend change. However, when you combine the bands with trend confirmation from higher time frames and volume analysis, that probability increases significantly, often into the 58 to 65% range. This is the professional gap. You aren't looking for a magic indicator. You are looking to stack small statistical edges together. Confirmation is the bridge between gambling and trading. Now, let's break down the mean reversion setup. Step 1. Identify a stock that is clearly moving sideways on the 1-hour chart. No strong higher highs or lower lows. Step 2. Wait for price to touch or slightly pierce the lower band. Step 3. Do not enter immediately. This is where beginners fail. Wait for a strong bullish candle to close back inside the bands. This proves that the stretch has snapped back and the mean reversion has begun. Entry occurs on the close of that confirmation candle. Your stop loss goes slightly below the recent swing low. Your first target is the middle band, the 20 SMA. If momentum continues, the upper band is your final exit. This setup works because in ranges, price is mathematically predisposed to return to its mean. In a strong uptrend, shorting the upper band is professional suicide. Instead, we use the bands for trend continuation. In this setup, the middle band acts as dynamic support. During a powerful move, the price will often pull back toward this 20-period moving average to reset its momentum. Instead of fighting the move, you wait for the pullback. Entry occurs when the price respects the middle band and shows a bullish reversal candle, resuming its upward trajectory. Your stop loss goes below the pullback low. Your exit can be near the previous highs or when the price accelerates into the upper band with signs of volume exhaustion. This method aligns you with the dominant trend, using the bands to find the most efficient entry point during a brief pause in the action. Always trade with the current. Now let's talk about the Bollinger Band squeeze, one of the most powerful concepts in technical analysis. When the bands contract tightly, it indicates that volatility is at an extreme low. Expansion always follows compression. When you see a squeeze, you are looking at a market preparing for a massive breakout. The rules for the squeeze are simple. Wait for the bands to reach their narrowest point. Then, wait for the price to break above the upper band with a surge in volume. This volume is your confirmation that institutional money is behind the move. Enter on the breakout. Exit when the bands begin to flatten. An advanced concept every master must know is band expansion strength. If price touches the upper band, but the bands themselves are widening aggressively, that indicates a surge in momentum. Fading that move or trying to short it is extremely dangerous. It's a sign the trend is accelerating. However, if the price touches the band while the bands are flat or starting to narrow, the probability of a mean reversion bounce increases dramatically. The slope and width of the bands tell you more about the energy of the move than the price level itself. Professionalism is about reading the shape of volatility. Before you trade a touch, look at the bands. Are they opening like a jaw or are they closing? This visual cue tells you whether to expect a reversal or a continuation. Context matters more than the touch itself. Behavior differs between large cap and small cap stocks. On highly liquid names like Apple, Amazon, or the major ETFs tracking the NASDAQ, Bollinger Bands behave much more cleanly. This is because high volume stabilizes price movement and prevents random outliers from distorting the standard deviation calculation. On thin, low-volume stocks, volatility spikes can cause repeated band breaks without follow-through, leading to constant, false positives. If you are looking for consistent results, focus your Bollinger Band analysis on the top 100 liquid U.S. equities. The higher the liquidity, the more reliable the bands become. You want to trade where the big money moves, as their institutional flows respect these mathematical boundaries. Trade where the math works. No strategy succeeds without strict risk management. Even with a high win rate, you will face losing streaks. If you don't manage your risk, you will blow your account before the probability can work in your favor. Aim for at least a 1 to 1.5 risk-to-reward ratio on mean reversion trades. On breakout trades from a squeeze, you can aim for 1 to 2 or even higher as volatility expands. We follow the 1% rule. Never risk more than 1% of your total capital on a single setup. If you have a $10,000 account, your max loss is $100. This math makes your edge sustainable. Professionalism is about managing your downside. The upside will take care of itself if your system is solid. Discipline is your only real shield in the market. Protect your shield at all costs. To summarize, Bollinger Bands are a powerful framework for measuring volatility, but they are not a magic crystal ball. Do not trade the band touch. Trade the context around the band. Identify the environment, wait for candle confirmation, and always respect the expansion strength. Spend the next week just observing these patterns. Look for the squeezes and the 20 SMA support bounces on large-cap U.S. stocks. Once you can see the volatility cycles in real time, you will have a professional edge. Remember, probability in trading is about stacking small edges together. Good luck with your trading journey, and I will see you in the next lesson.